All right, China's economic growth slowed in its third quarter, rising by 4.9% year over year, but still beating expectations thanks to increased consumer spending. While government stimulus boosted consumption in the world's second largest economy, the property sector continuing to drag down growth. Now, while China may be getting back on track to hit its year-end growth targets, ongoing trade disputes between China and the U.S., as well as rising geopolitical tensions, could begin to weigh once again. According to our next guest, large swaths of the domestic and global economies could be fundamentally weaker than top-line numbers suggest. Let's break down what all this means for investors, for the broader investor landscape. For that, we want to bring in Scott Sperling, Thomas H. Lee Partners co-CEO, THL. Scott, it's great to see you at Yahoo Finance. Thanks so much for taking the time to join us. So let's start with what has played out over the last week and a half, the growing escalation or threats here in the Middle East amid the war between Hamas and Israel. From your assessment, how big of a risk does this pose to investors in terms of what that opportunity could look like, or the challenges that could present in the coming months?
I think my assessment of the potential risk may be greater than seemingly the market has, which has not reacted all that adversely to the horrific events of the last week or so. The danger now geopolitically, I think Jamie Dimon made the appropriate comment, is the worst we've seen in our lifetimes. And as we think about trying to do business in that environment, and what the implications are for commodity prices of all sorts, for supply chains, and then just for fundamental demand for commercial as opposed to military goods, I think it raises all sorts of questions. Now, beyond that, we've obviously gone through a period of lots of firsts. Start with the entire COVID crisis, the complete shutdown of our economy, followed by massive fiscal and monetary stimulus that helped put us back on the right footing. The miraculous work, I would say, of our life science and healthcare sectors to deal with the health problems all put us in a place where we saw a massive run-up in the value of the equity markets, and correspondingly, even with the collapse of occupancy in the real estate market, for a long time held up the value of real estate, particularly residential real estate. I think all of those things are starting to unwind a bit. We've seen that in the adjustment to earnings expectations over the last 7 or 8 quarters, where the expectations have come down. We seem to generally meet those lowered expectations, but the trend has been obvious. The cost of capital has gone up dramatically. That has a way of working through the economic cycle with a number of different lags. And so I think we're starting to see the impact there. And the long-term outlook from a fiscal perspective is, to say the least, uncertain. So all of those things, I think, create levels of risk. Offsetting that is, again, amazing technology in both the life science side, and as we've seen with the movement in generative AI, that is so much faster than anybody expected. The technologies there can create opportunities in both places that have yet to be explored.
Sure. Okay, a couple things we want to unpack there. First and foremost, when you say high likelihood of a business recession here, you've got CEOs, especially from some of the largest banks, giving their kind of weather forecasts about the economy right now. And the latest coming from Morgan Stanley CEO this morning, saying that he does think the Fed is going to do one more rate increase by the end of the year, doesn't expect them to cut in 2024. What does that signal to you, if we were not to see a cut in 2024, about the likelihood of that recession, and ultimately if this higher for longer has a larger impact on the depth of a recession?
Well, higher for longer should theoretically have an impact on what the value of any given asset is, clearly. And we saw that with a collapse in mostly technology stocks, but stocks of all sort about 18 months ago, as people were coming to grips with the fact that inflation was not going to get defeated easily, that the Fed's job was very difficult, And I think now you're looking at a situation where not only is the Fed probably going to have to retain these higher rates longer because of the nature of inflation that we're dealing with, but the fiscal deficits are so large that the supply and demand equation, particularly as you look at the 2 to 10 year tranches of Treasury debt, we're just going to have an enormous amount of supply being put into the market, and it's not clear the demand will meet that unless you see higher long-term rates be sustained, even past the point that the Fed may start to bring down near-term rates.
So, Scott, it sounds like you see a reasonable possibility here that rates are going to stay in this elevated range. Is that correct?
Yes. I would agree.
And
I would agree with a number of I think, both banking leaders, but also business leaders who are seeing the same thing, which is, we're not fully defeating the forces of inflation. The wage push inflation that we see coming from, maybe appropriate demands, particularly from the union side, for double-digit wage increases over the course of the next 3 to 4 years is not abating. There are still a number of areas where there are labor shortages. And again, I think while technology can help solve some of that, it's going to take some time.
And then, Scott, to that point then, when we talk about the consumer right now, obviously consumer has been extremely resilient, pointed to in many instances as one of the reasons or one of the main reasons why the U.S. economy has been able to avoid this recession. If we are in this higher for longer elevated rate period here going forward, what is then the impact on the consumer and just what that would mean in terms of weakness that we could see more broadly speaking?
Well, I think you're starting to see, two facts emerge. One is that the massive amount of fiscal stimulus, putting money in the pockets of consumers, is starting to run out, and that's going to have an impact. The second fact is that you're seeing a massive increase in consumer debt, particularly credit card debt, and that obviously has a depressing impact on future purchases, particularly given the high rates for lots of different types of consumer loans, even putting aside the extraordinarily high rate of credit card debt. So I think those things will tend to dampen at least the growth of consumer demand going forward, and in many cases may actually bring it down.
Scott Sperling, Thomas H. Lee Partners co-CEO. Scott, thanks for taking the time this morning.
You're very welcome. I wish I had better news for you in any regard.
Soon, very soon, hopefully, Scott. We'll work on that too for you.